So today we'll be doing more of an introduction to the consolidated income statement. We'll do class to prepare the ground for the next time we'll be meeting and make the class quicker. So firstly, consolidated financial statement. When you pick up any consolidated financial statement question, it's always like a story. It's always historical. Who tells the story of when one company acquired another company, what happened on the day they acquired that company. Then afterwards, they then tell the story of what happened after they acquired that company. Sometimes the acquirer may acquire more than one investment or investees. Sometimes it may acquire 3, but for the purpose of basic learning, it doesn't go beyond the acquisition of 2 or 1 subsidiaries. So, given that storyline, for each aspect of the history, there is always a response. There is always something you must do. Recall how we said the history is broken down. First, what happens on the date of acquisition. The next thing is what happens after acquisition. To now make the question, should I say, more bulky, sometimes the acquirer may acquire another investment that will not be termed a subsidiary. So very shortly, we'll look at one hierarchy, then you would see how each question can be broken down into 3 sections, and that will lay the very good foundation to build up on solving questions. So I would project my Microsoft Excel document, which I will use more like my chalkboard. Okay, I have my document, Microsoft Excel document prepared now. So what I will do so that you can see clearly for yourself, and when I share this document, you also see clearly that a group accounting question can be broken down into 3 pieces. First, the aspect that relates to acquisition. The next one is post-acquisition. And the final aspect we'll mostly stumble into is an investment in associates. So in each of these 3 aspects, there is always something you should do. If you can master them one by one, you are home and dry. So remember the story. One company acquired another company. The first thing you would have learned is that before you consolidate, you must check whether there is control. That's where you would have learned about checking the group structure. Once it's above 50%, then there is control. A bulk of that has been learned under, taught by Mr. Muiwa when he was doing his learning on consolidated statement of financial position. So assuming there is control at acquisition, how does the story affect your preparation of profit or loss accounts? What we'll just be focusing on here is how it affects profit or loss accounts. So I won't concern myself with how it affects the statement of financial position, because the belief is that you're already in the process of learning that. So on the date of acquisition, how does the accounting affect the income statement? At post-acquisition, how does the accounting affect the income statement? When you have investment in associates as well, how does it affect the income statement? We'll be looking at it one by one. So we start with what happens at acquisition. At acquisition, your goal, let me put it this way, your goal is to calculate goodwill at acquisition. Once you calculate goodwill through what they refer to as acquisition method under IFRS 3, you are good to go. You have done almost half of the work. But in the process of calculating goodwill, you will need some ingredients. Assuming goodwill is a soup, you will need some recipes to cook the soup called goodwill. Let me throw it to the class. Please, who can help us with the formula, or should I say the format for calculating goodwill? Can somebody help us? You're already gurus in preparing consolidated SFPO, so you can't say you don't know how to calculate goodwill. If somebody does not help us, I'll point at somebody. I can see Mr. James, your hand is up. I see Okoyemi Olabi, your hand is also up. Is Mr. or Mrs. Okoyemi Olabi, please? How do we calculate goodwill? Your answer can be as simple as I don't know.
Okay, calculation of goodwill, is it under the statement of financial position now?
Sure,
as
sure.
we were told Okay, to my own understanding, calculation of goodwill, you check for the investment of the parents now in the subsidiary.
Okay.
The investment. Then you add up NCI's portion of the investment.
Okay.
Then when you add up, you get purchase consideration.
Okay.
Then you less the net assets of the subsidiary. You take it away from the investment, from the purchase consideration.
Okay.
So that's how you calculate it.
Yeah, makes sense. Thank you very much. So the formula, I will just write it out boldly. First, like you said, we have what they call fair value of consideration transferred. That's the first thing. Plus value of NCI minus fair value of subsidiaries net asset at acquisition. So by the time you stir these three recipes up, you would get your goodwill at acquisition. So this is equal to goodwill. If it is positive, then if it is negative, it's gain on a bargain purchase. This you would have learned previously. But my focus in this session is to now show you how each of these ingredients will affect the preparation of your consolidated statement of profit or loss and other comprehensive income. Here is the formula. Of course, what you will get here, if there is impairment loss in the question, you will need to adjust minus impairment loss. If it is goodwill, you will need to adjust for impairment loss. So most times, this first goodwill you get is like a goodwill at acquisition. So that once you deduct or adjust for impairment loss, what you now have is goodwill at reporting. So this can now be equal to goodwill at reporting. So this is something we're already familiar with. Like I said earlier, the focus is just on what you can see over there, how each of them will affect your preparation of profit or loss, even before you start solving questions. Now, the first ingredient is fair value of consideration transferred. Again, I want to put it to somebody in the class. Can you give us examples of different methods through which the consideration transferred can come? I know the most popular one is cash. Let me help you out with that. So cash. So any other one? Anybody from the class, please help us, teach us.
We have deferred consideration. Hello?
Yeah, well, with you, live and direct.
Okay, we have deferred consideration or a contingent consideration.
Okay, we have deferred consideration. We have contingent consideration. Which other one?
We have share exchange.
We also have assets.
Share exchange. Which other one?
We have assets, so asset consideration too.
Let's call it transfers of acquirers' assets.
Okay.
Then we have, I think, cash.
Yeah, cash is the first one. I've helped you with cash.
We have combination of cash and shares.
Sure.
Okay.
Sure. We're just looking at it on a standalone basis.
Okay, what of bank loan?
Yeah, loan note. Which other one have we missed out? I think this is the popular. These are the popular ones.
That should be loss.
You said? Hello, someone said something. Okay. So these are the popular consideration you stumble on in most questions. Again, by the time you stumble on this consideration, when you are dealing with an income statement, consolidated income statement, how do you handle each of these considerations? That's what we'll be looking into shortly. The second ingredient for calculating goodwill is value of NCI. And once you hear value of NCI, what you should always probe is to find out how is NCI valued. That will also have an effect at some point in preparation of the income statement. When we get to that point, I will also show you. So it's also important for you to know how NCI is valued. So the question here is, how is NCI valued? My people, what are the ways through which NCI can be valued? What are the methods? Please help me, I don't know it. What are the methods?
You have at proportionate share.
Okay, we have proportionate value.
And at fair value too.
Thank you very much. We have
at fair value too.
All right. So this fair value is fair or full value. This proportionate, sometimes they will not say proportionate, they can say partial. So we'll be looking at how this will affect your income statement. We're picking it little by little. The third ingredient is fair value of the subsidiaries' net asset at acquisition. When you get to this ingredient, there are two things you must always probe for again. The first thing is what they call the fair value adjustments. You would have learned that. And the next thing is what they call extra or reduction in depreciation. These are the two important things that you should always probe into as far as this third ingredient is concerned, fair value of subsidiaries' net assets. That's when they will now tell you that on the date of acquisition, the fair value of subsidiaries' net asset and its carrying amount are the same, with the exception of an item of PPE. All those stories, they like that story. And they will now tell you that it has its income 5 years, useful life, all those stories. They love it a lot. And when time we see it, we should be happy because we know how to handle it. So these are the two things you would probe or you search for in the question or deal with when you are handling this third ingredient. Once you stir these three up, these three recipes, let's call this one Maggi, let's call this one pepper, let's call this one curry. By the time you stir these three up, what you will now get, if positive, it is goodwill. Goodwill is an asset, so it will not affect your income statement as a value. However, if you have a negative figure, back in the days, they call it a capital reserve, they call it negative goodwill sometimes. But in today's accounting, it's referred to as a gain on a bargain purchase. So if you have such, you are expected to add it as an income. Most times it's better to just present it as a separate line in the consolidated income statement as an income, referred to as gain on a bargain purchase. So I will just put it down here. If goodwill, no impact on P&L, no impact on income statement. But if it is gain on a bargain purchase, let's say GOBP, add it as an income, separate line in the consolidated income statement. So that is it for goodwill and gain on a bargain purchase. If you now have an impairment loss in the question, how do you deal with that? That's the next thing. So if you have an impairment loss, how does it affect the preparation of your income statement? Number one thing you should do is to add that impairment loss to admin expenses or any line item stated in the question. So some question can tell you that your impairment loss added to cost of sales. Some questions will tell you that your impairment loss added to distribution expenses. Don't argue with them, do as they say. But if they are silent, you find even in practice, we usually add impairment loss to the administrative expenses. You will most likely add it to your administrative expenses. The most important thing, the bottom line, is that you should add it to an expense for the purpose of preparing your consolidated income statement. So when you see an impairment loss, just pick the figure or you calculate the figure as the case may be. Whatever figure you get, you add it to your admin expenses. What is the next thing you do with your impairment loss? At the point of sharing, the second thing is at the point of sharing for the purpose of sharing profit or loss for the year, deduct impairment loss on full goodwill. On full goodwill before any apportionment. So what happens? There is a fourth part. Let me just include that fourth part. The fourth part is apportionment. Apportionment of profit or loss for the year. Apportionment of P or L for the year. So when you get to that part, the impairment loss comes in handy when it's time to share, because when you are done with preparing your income statement, you have to share the profit between the parent and the NCI. So for the purpose of doing that apportionment, if there's an impairment loss on full goodwill, you must share that impairment loss on full goodwill. And here is just, this is just an overview of how to deal with each of these ingredients on the date of acquisition. So let's take it from the onset again. We'll take a deeper dive again into each of it. First, fair value of consideration transferred. Fair value of consideration transferred can come in any of these forms: cash, contingent consideration, deferred consideration, share exchange, transfers of acquirers' assets, and loan note. For cash, Cash in its own self, that means you pay cash immediately on the date of acquisition. Cash as an asset, the question is, does it have impact on profit or loss? No. So I will just say no impact on consolidated income statement. So if you stumble on cash as a consideration transferred, just cash on its own, then there is a likelihood that it will not affect the preparation of your consolidated income statement. The next consideration transferred, which you guys told me earlier, is deferred consideration. So the next question again is, once you stumble on a deferred consideration in your question, for the purpose of consolidated income statement, how do you treat it? Does it affect the income statement? Yes. A deferred consideration will affect the income statement through what they refer to as unwinding of discount. So the unwinding of discount is treated as a finance cost. So because of that, it would impact your consolidated income statement. So I will just paint this yellow. Remember, what is deferred consideration? Let me even throw that to my people. My people here, what is deferred consideration? Please just refresh my memory.
Deferred consideration is a consideration that does not have any condition that is attached to it.
Okay. Can anybody help us remix that? What the deferred consideration?
Hello, sir.
Yes, I'm with you.
Deferred consideration is like an agreement to pay later at an agreed date.
Exactly.
It's an agreement to pay.
Yeah, that's more precise. Like you are buying something on credit. You have collected the thing today, but you will pay later in the future at a specific period or time in the future. So that is why they call it deferred consideration. So most times you would have learned that because of the timing of acquisition and the settlement, there is always a gap. So you would have to discount that future value to present value. The difference between the future value and the present value will be treated as a finance cost. It will be spread over the period of time using the concept of unwinding of discount. So because of that time frame between the acquisition of the subsidiary and the payment for that subsidiary you acquired on credit, that difference, that time frame will create a finance cost because of the time value of money. I don't want to go too deep into this because I believe justice has been done to this by Mr. Muyiwa. So once you stumble on a deferred consideration, be rest assured that you have something that will impact your profit or loss account through finance costs. We'll use questions to demonstrate this. This is just a preliminary understanding. The next ingredient or form of consideration transferred is contingent consideration. Contingent consideration, let me see if I can learn from somebody again. People of God, please help me out. What is contingent consideration?
It is a future consideration.
Okay.
And it's based on occurrence or non-occurrence of future, maybe on certain event or something that may be possibility of something like happening or not.
Confirm, that's it. Give me an example of such an event. No idea. It's fine, you have done well. An example, a popular example is maybe profit target. When you want to buy a subsidiary and you tell the people who are selling the subsidiary to you that if the subsidiary hits certain profit targets, I will pay more money. So how does it affect the preparation of your profit or loss account? If you recall in your learning, contingent consideration is measured at fair value. So there could be a fluctuation in that fair value as a result of what they refer to as post-acquisition event. So when there's a fluctuation in the fair value as a result of post-acquisition event, then it will affect your income statement. Let me give an example. An example of an uncertain event is profit target. Me, Israel, for example, I want to buy a subsidiary. And the owners of that subsidiary, they begin to make mouth and fumble that, this subsidiary is a very profitable business. This subsidiary is the best thing that can ever happen to you. This subsidiary is mad, is this, is that, is fruitful. They are making a lot of mouth about the subsidiary they want to sell to me. I said, no problem. I will buy your subsidiary. If indeed that this subsidiary is that profitable, in 2 years' time, if this subsidiary earns a profit of 2 billion, I will pay you more money. 2 years down the line, the subsidiary did not attain that target. As a result of not attaining the target, there may be a change in the value of that contingent consideration. Because at acquisition, once we agree that in 2 years' time, I'll pay you more money, we value that contingent consideration. So if there's a fluctuation in the value as a result of post-acquisition event, that will usually hit the income statement. So the impact of contingent consideration will come in as a result of fluctuation in the value as a result of post-acquisition event. So that is how contingent consideration can affect your income statement. I'll paint it yellow too, because it has effect. The next...
Sorry, Mr. Israel.
Yeah, please go ahead, Okoyemi.
I'm sorry, please, can you just come again? I really want to understand that contingent consideration, the fluctuation in values.
Okay.
Please, can you just come again?
Sure, why not? First, recall we said that, I think someone explained, which was very fine, that contingent consideration is dependent on a future uncertain event. That means whoever is acquiring will pay more money, or sometimes whoever is acquiring will get a refund as a result of an event in the future. So we are standing on the acquisition date. For example, I gave example of myself that I wanted to acquire a subsidiary, and the owners of the subsidiary actually boasted that that subsidiary is very profitable. So me and the owner of that subsidiary, we now said, okay, this is what will happen. If that subsidiary that you say is profitable, if they make 2 billion worth of profit in the next 3 years, I will pay you more money. So you see that 2 billion worth of profit in the next 3 years, that is a future uncertain event. So me paying them more money is contingent on that. So on the date of acquisition, IFRS 3 would have required me to value that contingent consideration at fair value. But as time goes on, that fair value may be fluctuating as a result of things that may happen after the acquisition date. For example, stuff relating to the profit target. So if stuff after the acquisition date are happening and they are affecting the fair value, as that fair value is fluctuating, is expected to be, that fluctuation in fair value will be taken to profit or loss account.
Okay, thank you.
I hope that's clear.
Yeah.
All right. The fluctuation in the fair value, let me write that in full. Fair value as a result of post-acquisition events will be taken to consolidated income statement. The next one is share exchange. That means I want to buy a subsidiary. I don't have cash to pay, but I issue shares to the owners of that subsidiary. I use shares to pay it. When you go in, when you revise into what you learned there, the share exchange mostly affects your share capital and your share premium. So most times you'll find out that share exchange has no impact on income statement as a content of financial statement. So that share exchange, by the time you do the double entry, you do the calculation, the impact is mostly on the balance sheet and does not extend past the balance sheet, because it will be an additional figure to share capital and another additional figure to share premium. And most times those two amounts or those two items, you can't find them in income statement. If you are looking for share capital and income statement, something is happening. So most times share exchange, if not all the time, has no impact. No impact on consolidated income statement. So we are bringing it home little by little. The next one is transfers of acquirers' assets. Transfers of acquirers' assets. My people, please, can you explain this form of consideration? Transfers of acquirers' assets. Before I start pointing at people, please. It's like Okoyemi's hand is still raised up. It's like she wants to help us with what transfers of acquirers' asset means. Please go ahead.
No, I don't want to like.
Oh yeah, point at somebody. Point at somebody. Okoyemi, point at somebody. Don't be afraid. This is virtual. It's not like we're in physical class where anybody can harass us. Point at somebody. Look at the name. Just call any name you like.
Okay. Blessing.
Blessing. Blessing, they've called you. Thank you for answering your name. So these transfers of acquirers' assets, what is it about? Share your knowledge with us. Let's learn from you.
I'll call someone.
Yeah, I'll call another person.
I'll call Mary.
Mary. Can I? Oh, yes, I can see Mary Omotosho. Mary. You are doing as if you did not hear also. Mary.
Good morning, sir.
Yes, good morning, ma. Transfers of acquirers' assets. What is it about? Your answer can be as simple as, I don't know.
Well, I don't really think we have deep knowledge about that, but to me, it's my own understanding. I would say is when the parent company transfer part of their assets to the subsidiary.
To the owners of the subsidiary, former owners of the subsidiary.
Of subsidiary.
Not to the subsidiary.
Yes.
Yeah, that's on point. It's fine.
Yeah.
So if, for example, now I want to buy a company, I want to buy it fully so that I will turn it to my subsidiary. I don't have cash. I don't have shares to pay for the transaction. The owners of that subsidiary, I can tell them that they should take my land in Abuja, Asokoro, that they can have that land and they should give me their subsidiary. Or I will tell them that my Lamborghini that I parked in my compound, that they should come and carry it, then they give me their subsidiary. My Rolls Royce that I park in Osun State, these are the cars I own. You understand? I tell them that they should go and take the Rolls Royce and they should give me their subsidiary. So it involves me, the acquirer, transferring an asset to those owners. How does this affect the income statement? Transfers of acquirers affect the income statement in this way. Under IFRS 3, the standard requires that the difference between the carrying amount of that asset that you transferred and the fair value of that asset that you transferred, that difference should be taken to your profit or loss account. So that is how it affects income statement. So I will just put it there, difference between the carrying amounts and the fair value of the assets transferred is to be taken to profit to consolidated income statement. So that's how you find it affecting your profit or loss. I will paint this one yellow again because it is important. The last one is loan notes. That as well doesn't really have much impact. It doesn't have impact. It's transferring a loan note to the owners of the subsidiary. So most times, this will usually take care of itself in the balance sheet. So from here, you can see that we have 3 forms of consideration that you should always take care. Anytime you see them in a question, always pay extra attention because there may be loophole or there may be something you need
to get here.
Yes, okay. Okay, let's get here. Madam Esther, mute your mic.
Sir.
Mute your mic. Let's get here. So, these are the 3 ways it will affect your consolidated income statement. These are the 3 considerations rather that will affect your consolidated income statement. Always watch out for these 3 considerations when you are preparing your consolidated income statement. That's your deferred consideration, your contingent consideration, and transfers of acquirers' assets. Those 3 are important. Not that the other ones are not important too, but remember, our focus is how can it affect your consolidated income statement. Before I go ahead, we're almost done with that acquisition. Before I go ahead, people, do you have any question? Before I go ahead, people, do you have any question?
Hello, Mr. Israel.
Please, I'm with you, Ogami. Mr. Tunde, go ahead.
Morning, sir. I just want to ask if all these boxes that you painted yellow are going to be demonstrated in a question.
Definitely. You will definitely see them when we start solving questions, you will see them in a question.
Okay, sir.
This is just trying to point out important focal for you, key points.
Okay, sir. Yeah. And sorry, sir, I'm sorry to drag you back a bit.
Go ahead, boss.
Can you please kindly re-explain the gain on bargain purchase?
Okay.
How to treat it in the income statement, sir?
Sure, we'll get there. We'll get there shortly.
Okay. Okay, sir.
Yeah.
All right, thank you.
Yes, boss. So the second ingredient for calculating goodwill is value of NCI. Remember what we said, that once you are at this ingredient, what you should always probe for or search for in the question is, how is NCI valued? The value of NCI as a figure will not affect your consolidated income statement. That value as a figure is a balance sheet item, because if you remember, NCI is a line item in the balance sheet under equity. So that value as a figure will have no impact. However, the way NCI is valued will have an impact when it is time to apportion your profit or loss for the year. So key points here, the value of NCI as a figure would have no impact on your consolidated income statement. However, depending on the method, impairment loss would be shared for the purpose of apportioning profit or loss for the year. As simple as that. The bottom. So that is that. So don't forget, when you see the value of NCI, maybe they tell you that the value of NCI is 2 million. Don't go and take that 2 million and put it in your income statement. Oh, Israel did not teach you that. That value cannot affect income statement. What will affect income statement is how is NCI valued. That will now go further into how to share your impairment loss when you get to the final step, which is the 4th aspect we'll be looking into. Yeah, James has his hands raised. James, please shoot. Go ahead with your question. James, please go ahead with your question. You can unmute and go ahead with your question. Or are you just testing the raising hand icon? Okay, please go ahead.
I'm not testing. I'm not testing. Can you hear me now?
Yes, we can hear you. Shoot.
Okay, good morning, sir.
Good morning, boss.
Yeah, sir, please, I want to confirm, I want to ask question on impairment loss. Okay. I want to know how does it affect, because I'm not getting clear on that impairment loss before. So okay. Before you go ahead on there, how does it affect the consolidated P&L?
Okay, we are coming there. We are coming there. Okay. Yeah, thank you, Mr. James.
Thank you.
Yeah, so the next ingredient is fair value of subsidiaries net assets at acquisition. How then does that one affect your consolidated income statement? First, there is the concept of fair value adjustment. That's when the question will tell you that the fair value and the carrying amount are the same, with the exception of an item of maybe PPE. Most times they like PPE, or an item of intangible assets with a useful life. They like 5 years or 10 years, the useful life of 5 years or 10 years. When you are reading that line tells you about the possible fair value adjustment. Now, there are 2 points in time that the fair value adjustment may target. There may be a fair value adjustment at acquisition. That's if the difference between the carrying amount and the fair value is arising from the date of acquisition. If that is the case, there is no impact on consolidated income statement, because any of those differences will be used in calculating goodwill. Take note. So if you are looking at a question and they are telling you that the carrying amount and the fair value, they are different, and that difference is arising on the date of acquisition, ladies and gentlemen, such a difference will not affect your consolidated income statement. Because on that date, IFRS 3 is the man in charge. And IFRS 3 will tell you that any of such a difference will be used in calculating goodwill. That's where the concept of fair value adjustment comes in, if you can remember. However, if it is happening post-acquisition, the question will tell you clearly that maybe there is an asset that the fair value post-acquisition is different from its carrying amount. Maybe it's an item of PPE. Such may have an impact on the profit or loss. So let me give that as an example, maybe property, plant, and equipment. So if there is a difference between CA and FV arising from post-acquisition on an item of PPE or intangible assets, if there is such a difference, my people, treat in accordance with the relevant standard. For example, under IFRS 16, IAS 16 rather, under IAS 16, when there is a difference, when there is a revaluation, for example, the standard will tell you that when there is a revaluation surplus, you also take it to OCI. So by so doing, it will affect your consolidated income statement and other comprehensive income. If it's intangible asset, the same thing too. If there is a valuation deficit too, that one will affect profit or loss. I don't want to go too deep into other standards, but treat it according to the relevant standard. But in most questions, you see them testing you on PPE or intangible assets. So if there's an item of PPE that has changed in value post-acquisition, then you need to check whether it will give rise to a revaluation deficit or a revaluation surplus and treat it accordingly in the consolidated income statement. The second aspect, so that area, that post-acquisition area, I will see how I can paint it as well so that we can have areas affecting the profit or loss painted out and identified out. So the next one is extra depreciation. Up here, when you do your fair value adjustment at acquisition, if you can remember, there is usually the concept of extra depreciation or reduction in depreciation. Whatever the case, the effect of depreciation will affect your profit or loss account. The effect should be used to adjust your cost of sales or admin expenses. Okay, I think let's just make it admin expenses to make it more a little close to practice. So adjust your admin expenses or any other line item indicated in the question. So if the question said that you should adjust cost of sales for extra depreciation, don't argue, adjust cost of sales. If the question said that you should adjust admin expenses, don't argue, adjust admin expenses. Recall from your learning that this depreciation is an offshoot of what happens up here under your fair value adjustment. So if you do a fair value adjustment that creates an increase, then you have an extra depreciation. If you do a downward fair value adjustment, then you have a reduction in depreciation. That's how it works. Don't worry, this will still be illustrated in the question. So the next ingredient is gain on a bargain purchase or goodwill. I think somebody asked that question, and the answer is not far-fetched. Once it is goodwill, goodwill as a figure is an asset. So because it's an asset, that amount will not affect the income statement. But if you have a gain on a bargain purchase, a gain on a bargain purchase is supposed to be added as an income in the consolidated income statement. It should be a separate line most times, or preferably. So if you have calculated it and you get goodwill, it will have no impact on income statement because goodwill is an asset. But if you calculate it and you get a negative figure, it is referred to as gain on a bargain purchase. That figure should be added as an income in the consolidated income statement. I think that should address the question raised by, I think someone raised that question. I think this should address your question. Then to the final aspect, to the question raised by Mr. James. So once you have impairment loss, the first thing you do, add your impairment loss to administrative expenses or any line item stated in the question. Then for the purpose of sharing the profit or loss for the year, if you have impairment loss on full goodwill, it will also be brought in for the purpose of adjustment. So all these things are just to pick out the key points that affect the income statement. They will be illustrated in a question. That's next week when we meet to solve questions. So my people, look at it again. Those areas I've painted are the areas of focus when preparing an income statement. Those are the areas that will affect your income statement. People, any question? Any
Hello,
question?
sir.
Yes, I'm with you.
Sorry, can you come back to post this fair value of net assets?
Yeah, okay.
The post acquisition aspect, sir.
Okay.
You say if there is a difference between carrying amount and fair value arising from post acquisition, you now said treat in accordance with the relevant standard.
Yes.
Now it's going to affect our comprehensive income.
Yeah.
So in the comprehensive, which of the is it going to be a new line item, or we're adding it to something?
You can create it as a new line item. For example, if it is if for example they said that after the date of acquisition, the carrying amount of an item of PPE is 2 million and the fair value maybe is 5 million. That's a difference of 3 million.
3 million.
Yeah, under your learning in IS 16, you would have learned that such 3 million can be addressed as a revaluation surplus. within this context. So that revaluation surplus, you will likely see it as a line item on its own under other comprehensive income.
Okay.
Of course, much later I will show like an extract of a consolidated income statement so that you'll see that aspect. I believe you guys have done IS1. Have you?
Probably I missed the class. I'm
Okay.
not aware of that. Sir.
Okay, no problem. No problem. I will still just show an extract or a format of an income statement shortly.
Okay,
so
sir.
if
Thank you very much.
Yeah, like the one you asked, let's say for example the carrying amount is higher than the fair value. That's a revaluation deficit. That one will go to profit or loss. You can show it as a separate line item on its own. That's fine.
Okay.
Yeah.
Okay. Thank you, sir.
Yes, boss. My people, any question? My people, any question? Yeah, Daniel, you have your hands raised. Go ahead.
Okay, sir. I just want to ask, where you talked about extra depreciation.
Yep.
But I wanted to confirm something. Okay, after acquisition, probably within the year before the end of the year, if there is a revaluation and we have the fair value is higher than the carrying amount, so that means we would have to prepare, like, that means there's an extra depreciation basically. So how would that be treated?
Yeah, if the question says that depreciation has not yet been accounted for, of course, like you said, you have to calculate it. And whatever depreciation you get, you add it to your admin expenses. But if the question says that depreciation is added to cost of sales, you add it to cost of sales. But where the question is silent on where you should add or deduct depreciation from, do it against your admin expenses. Some questions will actually tell you that take it to cost of sales. You take it to cost of sales. But once the question is silent, just do it against your admin expenses. It appears more closer to what happens in practice.
Okay, sir.
Yeah.
Thank you, sir.
Yeah. Yes, I think somebody else has their hands raised. Ekemezie. Please go ahead.
Sir,
yeah.
My question is on it. My question is on impairment of loss.
Okay.
I want to understand what can come about on the impairment loss, because I'm not really clear on impairment loss when it comes to doing the calculations.
Okay. Firstly, this would have been, my understanding is that this would have been treated when you were doing SFP. But regardless, impairment loss is saying that your goodwill should reduce in value. I don't want to go into the nitty-gritty of calculating the impairment loss on some instances, but the question first can give you the figure. The question can tell you that impairment loss is 2 million. Sometimes the question can tell you that impairment loss is 10% or 20% of goodwill. And sometimes the question can now go further to tell you that the recoverable amount is so. You are now expected to use that recoverable amount to determine impairment loss. So there are different ways in which it can arise. It can be given to you on a platter of gold. Most times to be given to you in the question on a platter of gold. Then sometimes you have to calculate it by yourself. If they tell you 10% of goodwill, that means you have to first calculate goodwill, then you then multiply it by 10%. So I believe determining impairment loss is a learning you will be exposed to more under a consolidated statement of financial position.
Okay.
Yep.
Thank you, sir.
Yep. Any other person? No question. All right. So just go ahead. Recall what I said. Recall when we started, we said that the storyline of a group accounting question can be broken down into 3 pieces. We have the at acquisition, we have the post-acquisition, we have investment in associates. We are now dealing with each of the pieces. We said that the first piece at acquisition, your ultimate goal is to calculate goodwill. Once you can calculate goodwill or gain on a bargain purchase, you are home and dry. But the journey of calculating goodwill or gain on a bargain purchase, it takes you some ingredients. And those ingredients are what we have looked into. Those ingredients are what we have looked into one by one. So we picked each of those ingredients and we have identified how they affect the consolidated income statement. So any area we paint here has an effect. Then the areas we did not paint has no effect on income statement. Esther, I saw your hands raised up. Please shoot. Madam Esther, please shoot. I noticed that you have your hands raised up. Please go ahead.
Hello, sir, Mr. Ishwe.
Yeah, I'm with you, live and direct.
Good morning, sir.
Good morning.
Is on the issue of goodwill.
Okay.
I wanted you to speak further on goodwill. But I now discovered that you have started discussing about it. So I think I'll have to hold on to listening to you. Okay. I wanted to talk about goodwill because on the issue of goodwill, I'm not so conversant with the way it's being calculated.
Okay.
When Mr. Muyo was taking us. So I wanted to see if I can be able to get it through your discussion this morning.
Okay.
Let me just allow you to finish your discussion on it.
No, I'm already done with my discussion, but this is what I will just do. Can you see my screen?
Yes, I'm seeing the screen. I'm seeing it.
Can you see that area that I painted orange?
Ash. Yes, orange. Yes,
orange,
I can see it.
So we said that on the acquisition date, your goal, your target is your goodwill. But to get your goodwill, you need, any day, anytime, you need three things. The first thing you need is what they refer to as fair value of consideration transferred. The second thing you need is value of NCI. The third thing you need is fair value of subsidiaries net assets at acquisition. Any day, anytime. These are the three ingredients. So when you add 1 plus 2 minus 3, you will get goodwill. So what we just did basically was to say for each of these ingredients, how does it affect your income statement? But goodwill is just saying that you go to the market to buy something and you got home, you pour the thing on the floor. You compare what you paid with what the actual value is in the market. So the difference between the two is either you have overpaid or you have underpaid. If you have overpaid, there's something extra that you overpaid. For the thing to be selling as 2 million in the market and you now paid 5 million, there's something extra about that thing that you paid 5 million. That extra thing is typically goodwill by the time we put a name to it. But for the purpose of calculation formula, this is the formula used for calculating goodwill any day, anytime. Fair value of consideration transferred plus value of NCI minus fair value of net asset at acquisition. I will leave it at that. Then what we have underneath is just how each of the ingredients affect goodwill. Low button. That's where we ended our discussion. Okay. So that is the discussion at acquisition. Once you have handled all these ingredients, you are done with treating all these ingredients used in calculating goodwill. Then you can now look into the question to see, okay, what happened after the date of acquisition? That will now give rise to post-acquisition. When you open the question, when you start seeing that I buy goods or I sell goods from my subsidiary, then you know that you are within the terrain of post-acquisition. Post-acquisition is largely intra-group transactions. What you will see mostly under post-acquisition, they refer to them as intra-group transaction. After the date of acquisition, what you usually see is the subsidiary selling goods to the parent or the parent selling goods to the subsidiary, either ways. Or sometimes it could not even be goods, it could be just a transaction, it could be any form of transaction between the parent and the subsidiary. Even in practice, that's how it happens. You see the parent doing business with the subsidiary or the subsidiary doing business with the parent. So in the post-acquisition period, a large percentage of it, if not all of it, represents intra-group transactions. And typically, intra-group transactions can come in different forms. The first and most popular one is the sale of inventory. That's when the parent or the subsidiary sell inventory between each other. That's the parent sell inventory to subsidiary or subsidiary sell inventory to the parent. That's the first type, sale of inventory. The next form of intra-group transaction you may stumble on is sale of PPE. That's a buy and sell motor vehicle or land between each other if that is not part of their inventory. So sale of PPE is another form of intra-group transaction you may stumble on. Another form of intra-group transaction you may run into treating is what they refer to as current account balances. That's for every transaction that takes place between the parent and the subsidiary, each of them will record it. So when the parent sells 2 million to the subsidiary on credit, the parent will record it as receivables, but the subsidiary will record it as payable. So what is left to one person will be right to the other person. At any point in time, the balance recorded by the subsidiary and the balance recorded by the parent are expected to be the same. So that's where the learning of current account balances comes in. Most times, the difference between the two is caused by goods in transit or cash in transit. We'll look at how all these affect your consolidated income statement. Apart from current account balances, we also have intra-group borrowings. Intra-group borrowings. That's the parent lends money to the subsidiary or the subsidiary lends money to the parent. It could be either way. One person is borrowing, the other person is lending. Apart from intra-group borrowing, we can also have intra-group dividend. Intra-group dividend is not far-fetched. Remember, it was the parent that invested in the subsidiary. So at some point in time, the subsidiary will pay dividend and the parent will actually benefit from that dividend. So that is intra-group dividend. Sometimes we have what they refer to as intra-group management service. That's one, or maybe the parent is rendering a management service to the subsidiary or the subsidiary is rendering a management service to the parent. This is also very popular in practice. That's when parent or subsidiary, they are rendering some kind of services for each other. One person will charge and the other person will enjoy an income. Let me see if any other form of intra-group transaction is coming to mind. I think these are the top ones. But regardless, this is the principle under intra-group transaction. When there is an intra-group transaction, one party will be earning an income while the other party will be incurring an expense. That's what usually happens. So the principle is simple. Cancel the income, cancel the expense. Because the consolidated income statement, the consolidated financial statement, the parent and the subsidiary are seen as one. So any income and expense between the two of them must be canceled out completely. It must be knocked out. So the principle is knock out any income and expenses within the group. That is the principle under intra-group transaction. So recall, first thing, one party would have recorded income and another party would have recorded an expense. Your message is simple, your work is simple. Principle or task: cancel out any income or expense, any income earned or expense incurred within the group. That is the broad principle under the preparation of income statements. So this broad principle is then applied to each of these possible scenarios we have here. The first scenario is sale of inventory. How do you deal with sale of inventory? That means the parent has sold to subsidiary an inventory, or the subsidiary has sold to the parent an inventory. How do you deal with such? The first thing you will do, remember that the seller would have earned revenue, that is the income, while the buyer would have incurred an expense. So the first thing you will do is determine the sales value. It will be given in the question. If it's not given in the question, you will have a clue of calculating it. They can say that the subsidiary sells 2 million to the parent every month. That means in a year, they sell 24 million. Sometimes they may just give you the sales value straight. The sales value is 15 million. You will get it easily from the question. Once you identify the sales value, deduct the sales value, deduct the SV. Let me call the sales value SV. Deduct the sales value from revenue and from cost of sales. That's the second thing you will do. Pretty simple. The next thing you will do is to calculate what they refer to as unrealized profit. When there is a sale between the parent and the subsidiary, one of the parties may have earned a profit within the group. So one of the parties may have earned a profit within the group. So you calculate that profit that is within the group. It's called an unrealized profit. So calculate the unrealized profit. It is based on unsold inventory. So unrealized profit is added to the cost of sales. Add unrealized profit to the cost of sales or any line item specifically indicated in the question. Most times it's usually the cost of sales. Yeah, please go ahead. Before I go ahead, ask your questions. Yeah, go ahead.
Can you please come again on the unrealized profits, sir?
Sure. Who am I? I'll come again.
How to get unrealized? Okay.
Yeah, I will just explain it. This is just like an intro. Remember, we would still illustrate these things in a question. So firstly, the concept of unrealized profit. Let me just do a little drawing here. This is P. P is the parent. And this is S. S is the subsidiary. P sold 100 million worth of goods to S. So since P is the seller, P will recognize it as revenue. He was one who sold. Then this guy is the buyer. He would have recognized it as a cost. So remember the principle that one party would have recorded an income, another party would have recorded an expense. Cancel the income, cancel the expense, knock it out. Secondly, that party who has recognized an income may have also earned a profit. Are you there? So that party may have earned a profit within the group. So the profit within the group is expected to be eliminated as well A profit will leave the group if this guy, this S, sells it to an external person. Let's call this external person EP. So if after S has bought from P, S now sold it to EP again, then any profit between S and EP has been realized. But any profit between P and S is still within the group. Such a profit must be eliminated. So we always calculate unrealized profit based on what they call unsold inventory. That is the amount that S has not sold to an external party. We will illustrate it in a question. So that any amount that S has not sold to an external party represents an income within the group. Such a profit will be added to cost of sales. By adding it to cost of sales, you are eliminating it. Remember that when cost of sales increases, profit will reduce. So by adding it to cost of sales, it means that you are removing it from profit. That is the logic behind adding the unrealized profit to cost of sales. I don't know if that is clear enough. I am not sure. I think it's Mr. Tunde who asked that question. I don't know if that's clear enough. If it's not clear, be rest assured. Yeah, be rest assured that once we start solving questions, it will get clearer. They are very simple, all these things. They may look bulky, but when we start solving questions, you'll see that they are not much.
Okay.
All right.
All right, thank you, sir.
Yes, boss. So for the sale of PPE, it's still the same logic that you stumble on under sale of PPE too. I think I will just, okay, M. Salami raised hand. Oh yeah, Mr. M or Madam M. Salami, please ask your question.
Hi, Israel. Good morning.
It's a lady. Yeah, good morning. No.
Yeah. So yeah, sorry, I don't know. I really struggle with understanding some of these basics when it comes to intra-group transactions. Okay. And so, for example, now I acquire a subsidiary.
Okay.
And I bought a good from the subsidiary.
Okay.
Fine. It's understandable to knock off since it's still the same. It's more like the same entity since they're doing a consolidated income statement, right?
Yeah. Yeah.
But then, you know, out of this 100 million now that I've recognized as revenue, my profit is part of that 100 million, right?
Okay.
So now, if you are saying I should knock off 100 million, knock off 100 million from revenue and 100 million from cost, indirectly, I have knocked off my profit already.
Okay.
So where does unrealized profits come in again?
Okay.
And then, I think that.
Okay. Okay. Have you guys passed through this under consolidated statement of financial position?
We've done consolidated SOFP.
Okay. Now, if you recall, when you are making your adjustment for unrealized profit in your SFP, you always remove it from inventory.
We've not done unrealized.
We've not done that.
We've not done that.
Oh, okay. What is there is that in determining the profit, remember that cost of sales is opening stock plus purchases minus closing stock. That closing stock, there is an element of profit inside. And because there's an element of profit inside that closing stock, it is now affecting your gross profit. Remember that the higher the closing stock, the higher your gross profit. So what we are majorly targeting is that closing stock. Remember I said that it is the unsold inventory that is giving rise to an unrealized profit. So the unrealized profit is locked inside the closing stock. So that is why is more of the closing stock that we are adjusting as a component of cost of sales. So that is why we also have to adjust that cost of sales as well. I don't know if you are with me. When you do your SFP, you also learn that that unrealized profit will be removed from inventory in your balance sheet, which means that the item that is causing katakata in that cost of sales. The next item causing it is your closing stock. So it is your closing stock that you are adjusting for unrealized profit. That is the reason behind knocking out unrealized profit. It's true what you have said, but closing stock is still sitting there with a profit element. That's why we need to adjust him. I hope that's fine, Madam Salami.
Israel, sorry, please. I don't know. Saying closing stock still has unrealized profits. Really, I don't understand.
Excuse me, can I ask a question, sir?
Okay, go ahead.
When you say we should determine the value, the sales value of the.
Okay, hold on. I think your question is now different, though. Let us pick it.
You can answer it together. You can just answer it together. What I'm saying is that you see the whole value of the stock, the transfer to each other, we are going to knock off, or the remaining balance of the stock we are knocking off.
It's this whole value, sales value.
The full one, not the remaining one.
Not the remaining one, the full value.
Wow.
So sorry, how is the profit element now?
Where is the unrealized profit is coming from?
In stock.
That's what I'm saying. Look at it. Let me do a format of you have revenue, you have cost of sales. Abi? Then afterwards you have gross profit. Let's say this one is 200. This one is let's say is 120. That means gross profit is 80. So now,
yes.
To get this cost of sales, if you remember from elementary accounting, cost of sales is opening stock
at purchase
plus purchases, then less closing stock. And the cost of sales thereby is 120. Let's assume this one is say 200. Let's say this one is 120. Then closing stock. That means if you add these two up, it's 320. Then closing stock is 200. So that means cost of sales. That's how that 120 was derived. Are you with me? So let's assume that this cost of sales here, it was derived as a result of this arithmetic. Now, removing the 100 million. Remember, the 100 million is the full value. Let me not say 100 million, let's say 50 million. 50 million is the full value. That's the full sales value, not the unsold inventory. The full sales value. That's this minus this. The full sales value. Same thing again, this minus this. I think this should be plus. Are you there?
Yes.
Aha. So what you have adjusted here is this cost of sales. There is also an unrealized profit element inside this closing stock here. What you adjusted is just sales value. So inside here, there's still an unrealized profit element that is within the group that must also be removed from the closing stock. Remember, under IAS2, inventory should be measured at the lower of cost and net realizable value. That's under IAS2. So inside this closing inventory, there's a profit element sitting inside that must be removed. Otherwise, apart from the fact that it's intra-group profit, it may also be violating the principle under IAS2 because there's a profit element inside this 200. As a result, you also have to adjust this closing stock for that profit element. So that is the reason behind doing an unrealized profit adjustment for the closing inventory at the end of every year. If it was statement of financial position, the closing balance of inventory will also be adjusted for that unrealized profit element that is sitting inside here. What you adjusted before is cost of sales as an income statement item. The next thing is this closing stock as a balance sheet item that is sitting inside this cost of sales. Madam Salami, I just hope this is clear enough.
Israel, sorry, let me ask one more question.
Yeah, go ahead.
So now, this purchase is coming from, let's say, it's coming from the person that bought, right?
Yeah.
So even if, so are you saying the way I'm trying to understand it now is the selling company, let's say the parents now was one that sold the good, and this let's say the subsidiary was one that sold the good,
okay,
right? And they were the one that recognized profits. Why the parents was the one that bought the goods? Oh, sorry, how do I explain this now? Okay, let me put it like this: the parents sold the goods.
The question is, who is holding the closing that inventory? Who is holding the inventory?
So now my concern is, if I was the one that sold the good, the other party purchased. So now, are you saying the profit element that the other party that sold to me has recognized is in my closings, is in my purchases? Is that what you're?
Yes, it's in your closing inventory. Until you sell it to an external person, then the group will earn it. But the fact that it's still in your closing inventory, the group has not, that profit is still within the group. So inside your closing inventory as a buyer, there's a profit element inside, which is not only violating the IS2 requirement for measurement of inventory, it's also violating the fact that once you have added that figure to your closing inventory, because the higher your closing inventory, the lower your cost of sales, automatically the higher your profit. So by having a profit element inside your closing stock, your profit has also been affected. So that is why we have to adjust this closing stock. That's the reason. For example, look at now, let's assume everything here remains the same. If we tweak closing stock, let's say closing stock is 250. That means cost of sales will be 70. If cost of sales is 70, that means profit will be higher. The reason why this closing stock is higher by this amount is because there is a profit element inside that has affected the profit value. So it's like bloating, overvaluing your inventory. Because you have overvalued your inventory, your profit is now higher than it's supposed to be. That's the angle that adjustment is coming from. Madam Salami. Hello?
Hi, sorry, I have bad network.
Okay.
I just joined.
You know what will happen? Let's just, so that we don't burn too much of our time, we can always discuss this after this class.
All right.
Yeah, I hope that's fine. And any other person that sees it as a gray area, we can always have a chat over it on WhatsApp. It's not complex.
Okay, but I think I got a clarification. I don't know if you want me to just
please go ahead.
What I got.
Go ahead.
Okay, so what I understand now is, assuming the parent company sold the goods to the subsidiary at 100 naira. Meanwhile, the real cost of the good was 50 naira. Okay. So now the subsidiary recognizing 100 naira. Meanwhile, 50 naira was actually the cost.
Yes.
So now we are trying to recognize the extra 50 naira.
Exactly.
Right?
Exactly. Because it's making the closing inventory bigger than it's supposed to be.
Is it making it bigger or lesser?
No, it's bigger. Remember that the cost is 50 naira, but
okay,
he paid 100 naira. So his closing inventory is now 100 naira, whereas the closing inventory should have been 50 naira.
Okay, yes.
So because of that profit element, the closing inventory is now bigger than it's supposed to be.
Yeah, because of the extra 50 naira that the subsidiary has recognized.
And if the closing inventory is bigger than it's supposed to be, profit will be higher than it's supposed to be. The relationship between closing inventory and profit is that the higher the closing inventory, the higher the profit.
Oh, I get now.
So that is why we are removing that profit by adding it to cost of sales so that profit will reduce.
Okay.
That's the idea behind calling it an unrealized profit.
Okay. So the unrealized profit is coming from the sales, the profit that the whoever sold has made.
Yeah, they now pushed it to the buyer.
Okay. Who is the related party?
Yeah.
All right.
If it's still not clear, please don't hesitate to send me a chat after the class. I'm on standby. Okay. So that's how to deal with sale of inventory if you stumble on it in a question. Then for sale of PPE, unlike inventory, for PPE, the unrealized profit is a gain on disposal. For inventory, it's unrealized profit. But for PPE, it's a gain on disposal. That means the parent has sold to the subsidiary or the subsidiary has sold to the parent. When the subsidiary made the sales or when the parent made the sales, whoever is the seller earned a gain on disposal. Remember that when you sell your property, plant, and equipment at a value above its carrying amount, you will have a gain on disposal. So that gain on disposal is expected to be knocked out as well. But we have to be very careful when it deals with sale of PPE, because depreciation is standing somewhere doing its own confusion. So when you sell PPE, first, what you will do is to calculate the gain on disposal. How much was the gain that that person earned on disposing that PPE to his subsidiary or to his parent or to our parent? When you have identified the gain on disposal, the next thing is to now say, okay, out of that gain, remember that depreciation would have also been adjusted for. Remember, when you buy an item of PPE, you also adjust it for depreciation. So out of that gain, depreciation would have eaten some portion of the gain on disposal. Remember that depreciation is an expense. Gain on disposal is an income. So depreciation has helped us cancel some portion of the gain. What we should concentrate on is the portion of the gain that has not been canceled by depreciation. Take note. First, calculate your gain on disposal. 2, have the understanding at the back of your mind that because of the gain on disposal, depreciation has been higher than it's supposed to be. So because of that, the idea is that depreciation would have reversed some of the gain. So it is the portion that depreciation has not reversed that we are expected to cancel out. So the second step is to identify the portion of the gain on disposal that has not been reversed by depreciation. And how do you do that? Let me project the PDF document I sent to you guys. It's there. So here it is. That's the second one. One party would have recognized depreciation, while the other party would have recognized a gain on disposal of PPE. Both depreciation and the gain of disposal are expected to cancel each other out. However, there will still be a portion of the gain that is yet to be canceled. That portion must be reversed as follows. So look at the formula here. So what is the number of years that is yet to be depreciated divided by the total useful life times the gain on disposal? We'll also look at this in a question. So the focus is usually which portion of the gain on disposal has depreciation not reversed, because we are expected to reverse all the gain. But along the line, depreciation has already assisted us in reversing a portion of the gain. We are just expected to concentrate on only the portion that has not been reversed by depreciation. I don't want to overflog that. I think it may best be explained when we start solving them questions. To the next intra-group transaction, we have current account balances. Current account balances, most times they involve balance sheet items. However, to the extent that it affects inventory, calculate unrealized profit and adjust it as in the case of sale of inventory. So current account balances, knocking out the balances, receivables and payable will not affect your income statement. But when the difference is as a result of inventory in transit, then you may need to calculate an unrealized profit, just like we did under this sale of inventory. This might also be best be explained through a question. Intra-group borrowings, again, one person is the lender, another person is the borrower. The borrower would have incurred finance costs, and the lender would have earned interest income. The principle is simple. Cancel first, number one, determine the intra-group interest. Secondly, cancel. Or let me not use the word cancel. Let's be more specific. Deduct interest, intra-group interest from interest expense. No, another name for interest expense is finance cost and interest income, or any income item this has been included in. So it still follows the same principle. Identify where the income was treated, remove it from the income, remove it from the expense, which aligns with this overall principle we have up here. One party has recorded an income, another party has recorded an expense. Cancel the income, cancel the expense. Pretty straightforward. Intra-group dividend, on the other hand, too, identify or calculate the dividend, the total dividend paid by the subsidiary. Let's say paid/declared by the subsidiary. Then secondly, calculate the parent's share of the total dividend. This is based on the parent's shareholding in the subsidiary. Once you have done that, deduct the parent's share of intra-group dividend from the income it was initially added to. Straightforward as I think someone sent a chart. Let me see. Oh, this chart is not opening. Please, whoever sent the chart can just, I don't know, it's not showing here. You can just project your voice and let's address it. If it's a question you asked. I don't know why the charts are not showing. So who sent the chart? Please ask your question.
There is no chat.
Okay, it's fine then.
There's nothing on it.
Okay.
Yeah. My question, I raised my hand.
Okay. Okay.
My question is on the sale of PPE because
Go ahead. We don't have much time.
Explained at the acquisition date that there's transfer of PPE at the acquisition date. So I'm trying to compare the transfer and the sale. Are they the same thing?
No, they are not. They are not. The one that happens on the acquisition date is between the parent and the former owners of the subsidiary. Remember that on the acquisition date, the parent is buying the subsidiary from its owner or owners. Yes. So it's between the parent and its former owners. But what happens during the post-acquisition period is between the parent and the subsidiary.
I'm a bit confused. But that's still the same subsidiary, or they get changed?
Just follow me closely. On the acquisition date, when the parent acquired the subsidiary, he acquired the subsidiary from somebody.
Yes.
That person he acquired it from, the parent and that person, they are the one that will be doing transaction on the date of the acquisition. So any consideration, the parent will be transferring it to that person or those people. I don't know if you get, that's what happens on the date of acquisition. So the transaction is not between the parent and the subsidiary on the date of acquisition. The transaction is between the parent and the former owners of the subsidiary. Did you get that drift?
Yes, I get.
But on the during the post-acquisition period, the transaction is between the parent and the subsidiary. Because the parent and the subsidiary are now in the same group.
In the same group.
Yeah.
But it's even run by a different person or the same group.
No, you know, at the initial stage, it was a different people that were running the subsidiary. But when the parent buys the subsidiary, it's now the parent that is running the subsidiary.
Okay.
It's very important to understand it too. At the acquisition date, it is parents dealing with former owners of the subsidiary. But during the post-acquisition period, it's parents dealing with the subsidiary, intra-group transaction. All right, thank you very much. So the last one is also an intra-group management service, which is similar to what we have seen earlier. One party would have incurred an expense, while another party would have earned an income. The expense and the income are expected to be knocked out against each other. Then the third aspect, which is the last part, is investment in associates. So when you have an investment in associates, that's an investment with a shareholding of say 20% to say 49%. Remember, that's just quantitative assessment. In practice and in more advanced learning, you might even have 70% and it will still be an associate. But at this level, 20% to say 49% is an associate. So when you have an associate in a question, you don't need to disturb yourself too much. Here is how the associate will affect the income statement. The associate will affect the income statement. Bless you. The associate will affect the income statement through what they call share of associates' profit or loss for the year. Profit or loss for the year. So how is that calculated? First, I think let me just use the PDF document and project. That's the final aspect. So that's calculated by as projected. First, you get the parent's share of the profit or loss for the year, which is represented as X here. You get the impairment loss. It's supposed to be an X here as well. And you get any unrealized profits. By the time you add these three up, the final figure will be presented as a separate line item before profit, before tax. So if this final figure is positive, that means it's an income. But if this final figure is negative, that means it's a loss from the associate. So these are the three things you add together to get the income or loss from the associate, which is the last aspect of the additional information. Once you have dealt with the income or loss from the associate, the final thing that we usually do is to share the profit or loss for the year. And sharing the profit or loss for the year will require you to make use of this format as well. Sharing the profit or loss for the year. So this is the subsidiaries profit or loss, and these are the adjustments that will be made to determine the adjusted profit or loss. And thereof, NCI will take its share, and parents will also take its share. Once you're able to do this tends to be tricky, but it's quite simple. When we start illustrating, you'll see it for yourself. So once you're able to conclude on this fourth aspect, then you are fine, you're home and dry. The question is done. You earn your free marks. So before I round the class up, remember how we started. We said that the typical group accounting question can be broken down into three aspects. We have the storyline at acquisition, and we said that the goal here is towards goodwill or gain on a bargain purchase. We said that when you are calculating goodwill, there are three ingredients you will need. The first ingredient is fair value of consideration transferred. Let me just project that real quick. Here we are. So the first ingredient is fair value of consideration transferred. The second one is value of NCI, net asset at acquisition, then goodwill or gain on a bargain purchase. For each ingredient, we have examined how it will affect the profit or loss account for each of them. We also learned shortly that once you are at acquisition, these dealings, this consideration transferred is between the parent and the owners of the subsidiary. So once you acquire that subsidiary, that investment and make it your subsidiary, the next thing is the post-acquisition transactions. Post-acquisition transaction is transaction between the parent and the subsidiary, and they can come in different forms, which we have highlighted. After dealing with post-acquisition transactions, the final aspect is the investment in associates, which we also showed how to calculate the income from the associate, the income or loss from the associate. And afterwards, we also learned about the apportionment of subsidiaries' profit or loss for the year. By the grace of God, in our next class, all this story we are saying will be illustrated in exam standard questions. So before we conclude the class, please, do you have any questions? Any question? Any question?
No question. Maybe
all right.
We'll go through the notes.
All right. Thank you very much. So the recording, once the recording is uploaded, it will be shared with you again by Mr. Muyiwa as usual. Thank you very much for your time. I'm grateful. If you have any other question again after the class, please, you have my number. Send me a chat ASAP. And once I'm able to, I will respond to you. Thank you. Have a great day ahead.
Have a nice day, sir.
Yeah.
You too, sir.
Thank you, sir.
110.